Today, we are pulling back the curtain on one of the biggest, most complex industries in the world, insurance. We're going to uncover the secret formula they use to stare into a totally uncertain future and not just survive, but actually thrive.
Okay, so let's just jump right in with a huge question. Think about it for a second. An insurance company's entire business model is built on making promises about the future. So what on earth happens when that future turns into a total catastrophe and literally thousands of claims all land on their desk at once? How do they not just go bankrupt?
Well, you might think they've got some kind of crystal ball, right? But the answer is actually so much more interesting. See, they don't predict the future. They have a system for managing it. And that little shift in thinking, well, that's the key to everything.
When you get right down to it, insurance is a business built entirely on uncertainty. But here's the thing. Instead of being paralyzed by what might happen, these companies have built this incredibly powerful, systematic way to handle pretty much whatever comes their way. They're not just reacting, they are actively shaping how they'll respond to future events before they even happen.
So how do they actually do it? Well, they use a framework. You can think of it like a universal toolkit for understanding and dealing with threats. And once you see this toolkit, you'll get how they can confront almost any challenge you can think of, from a massive hurricane to a single rogue employee.
First things first, we need to define risk the way they do. It's not just some vague feeling of danger. In their world, a risk is a very specific future event. And every single event has causes that lead up to it and consequences that follow it. Now here's the magic trick. You can't control the event itself, but you can control the causes and the consequences.
And here's a perfect way to think about it. Imagine you're driving a car. You can't magically prevent another car from hitting you. That's the event. But you absolutely can control your speed, right? That changes the likelihood of an accident. And you can wear a seatbelt, which dramatically changes the impact if one does happen. See? You're managing the risk without ever predicting the future.
And this brings us to the really simple, kind of beautiful formula at the heart of it all. The severity of any risk is just its likelihood multiplied by its impact. That's it. How likely is it to happen, and how bad will it be if it does? Every single threat they face can be broken down this way.
Now, this is where that simple little formula turns directly into a strategy. This right here is the toolkit. It's so simple. If a risk has low likelihood and low impact, you just accept it. Not worth the effort. If it's very likely, but the impact is small, you actively manage it with a bunch of controls. Now, what if it's not likely to happen, but the impact would be catastrophic? You transfer that risk to someone else. And finally, if it's both highly likely and high impact, well, you just avoid it. Don't do it. 4 simple strategies for basically any problem.
Okay, but that's the theory. Let's see how this toolkit is used to solve real, multi-billion-dollar problems every single day. Let's put it to the test. Imagine this scenario. A massive, once-in-a-century flood hits a huge region. An insurance company is suddenly facing thousands upon thousands of claims, adding up to hundreds of millions of dollars. This is a classic low-likelihood, high-impact event. So how does a company actually survive that kind of hit? Well, they survive because they don't take on all that risk by themselves. If they didn't have a plan, their potential loss is basically unlimited. It could bankrupt them. But with the right tool from the toolkit, they can put a hard cap on their financial damage, which protects the entire company.
The strategy here is transfer. They use something called reinsurance, which is, and this is great, literally insurance for insurance companies. They pay a fee, a premium, to an even bigger company called a reinsurer. That reinsurer then agrees to cover any losses above a certain amount, say $100 million. Just like that, the risk of a catastrophic loss has been transferred. Problem solved.
Okay, cool. But what about a totally different kind of risk? Not a natural disaster, but an internal one, a human one. What about mis-selling? When maybe a few agents start misleading customers to hit their targets. Now, this is a high likelihood, low impact problem. It happens pretty often, but each individual case isn't going to sink the company.
For something like this, you can't just transfer the risk away. You have to get your hands dirty and manage it. So companies put a whole series of controls in place. Way better training that focuses on what the customer actually needs. Follow-up calls after a sale to make sure the customer really understood what they bought. And of course, clear penalties for bad behavior and rewards for good behavior.
This is the managed strategy in action. All those steps, all those processes are designed to do one thing: reduce the likelihood of that bad event happening.
You're not going to eliminate it completely, but you're actively, constantly managing it down to a level that's acceptable.
So we've seen how the toolkit handles giant disasters and internal fraud. But the reality is, it gets way more complex. The most successful companies are using this exact same framework for hundreds of threats that are way less obvious.
Yeah, it's not always about the huge, headline-grabbing events. The real day-to-day survival of an insurer depends on managing this massive portfolio of operational, financial, and reputational risks that are just constantly bubbling under the surface.
And the variety is just staggering. I mean, what if some negative news tanks customer trust overnight? What if a critical computer system fails or you get hit by a cyber attack? What if a regulator just changes the rules with no warning? What if you lose contact with your policyholders or your investment funds start doing poorly? Every single one of these is a risk that needs to be found, assessed, and managed using that same toolkit.
Okay, so why should we care about all this internal corporate machinery? I mean, who cares how they manage their risks? Well, it matters because it all points back to a single, fundamental promise that they make to you, the customer.
This entire system of risk management, it isn't just about protecting profits for shareholders, it's about longevity. It is about making sure that the company is still standing 50, 75, even 100 years from now, ready to pay out on a life insurance policy that was signed today. At its heart, it's the foundation of trust.
And as the source material for this explainer puts it so well, it all comes down to reputation. Every single process, every control, every decision is another brick in the wall of that reputation. The risk management toolkit, in the end, is a tool for building and protecting trust over a very, very long time.
So, there you have it. We've seen how this simple framework of likelihood and impact helps these massive companies navigate an incredibly complex and uncertain world. The final question, though, is for you. This toolkit helps them tame the future. How could thinking about likelihood and impact help you tame the uncertainty in your own life or your own work?